Well, Roger McEowen with the Washburn University School of Law joins us now to review another tool for the process. And Roger, as always, thanks for your time here today. Today we're talking about GRAT. What exactly are some of the basics that we need to know about this, and actually, what is it?
Well, what is it? It's a special type of irrevocable trust. It's called a Grantor-Retained Annuity Trust. That's where the acronym comes from. And you transfer property into the trust, and in return for that transfer, you get a fixed annuity payment for a term of years, with the remainder beneficiaries then getting the remaining assets at the end of that annuity term. And that fixed percentage is drafted to be a part or a percentage of the asset's initial fair market value, and it's computed in a manner that the transfer doesn't result in any gift tax. So it's gift tax free, the property's out of the transferor's estate, and then it goes to the beneficiaries. That's the idea behind a GRAT. And so you put highly appreciating property in there, and you move that appreciation to the next generation at very little to no tax cost.
Are there any tax consequences, though, of using the GRAT?
Well, from an income tax standpoint, the GRAT is a grantor trust. And what that means is that the individual grantor is taxed on all the income items of that trust and can claim all the deductions and credits associated with that trust. And so any royalty income, any farm income on those assets is just going to pass right through back to the grantor. But the annuity payments are tax-free. The grantor is not taxed on those annuity payments.
And Roger, what about the advantages and, of course, the disadvantage folks need to keep in mind when using this as a tool?
Well, I think the largest advantage is on the gift tax side of things. So if you have a very large estate, you're potentially facing federal estate taxation, and this could become a bigger issue in future years if Congress reduces that exemption down, then that gift tax-free transfer to the trust is really a big advantage. And if those assets can continue to grow in value, that grows outside of any potential estate of the grantor. On the downside, you could use up your exclusion on funding the trust. But with the exemption being over $12 million right now, you can still get a lot of property in that trust and perhaps not use up all of your exemption. But again, that's an issue we have to watch if Congress changes the rules.
So Roger, all things considered, what would you say is the big takeaway here?
Well, I think this is really beneficial in the right situation. If you've got a large farm or a ranch, you've got highly appreciating assets in there, this is a great tool for you as part of your overall estate and business planning tool. But it's really complex, and it has to be drafted properly, so you got to get good help.
All right, Roger, as always, thank you very much for your insight here today. Roger McEowen, he's with the Washburn University School of Law connecting with us today out of Kansas. Go online to washburnlaw.edu/WALTR for more information.